Hello and welcome back to Money Never Sleeps. My name is Bob Cruces from M&A Wealth. If you'd like more information about what you hear during the show, give us a call at 866-973-3627 or visit us online at mnawealth.com. And while at my website, click on the page to check out past shows and subscribe on Apple Podcasts or Spotify. While we addressed Social Security and the big beautiful bill during the previous episode, I thought it would be a good idea to go into more detail about it during today's show. We'll begin today's conversation by looking closely at a USA Today article, Social Security Tax Breaks, what the big beautiful bill really means for 88% of retirees, which I think nicely breaks things down. At the outset, let me be clear that I don't have a political dog in this fight. I simply do my best to find the facts and then share them. And as I'm sure many of you already know, some people think this new budget bill is great and others think it's a nightmare. Such is the nature of politics, I guess. First, let's look deeper into the claim that 88% of people receiving Social Security won't pay any taxes on their benefit. According to the article, that 88% figure was touted by the Council of Economic Advisors, among others. One of the big talking points is that 88% of Social Security recipients could soon be exempt from federal taxes on their benefits. And while that headline sounds great and it's meaningful, it's also important to understand the full picture. Here's what we know. First off, this isn't a jump from 0% to 88%. Right now, about 64% of seniors age 65 and older already don't pay federal tax on their Social Security benefits. That's thanks to existing exemptions, deductions, and income thresholds. The current proposal would increase that number to 88%, mainly by introducing a new deduction. For those who qualify, it would reduce the taxable portion of their Social Security income, in some cases down to zero. But it's not a total elimination of taxes on benefits. The deduction amount is $6,000 per person, and while that could offer real relief for many retirees, it's also important to note that this deduction is set to expire in 2028. So unless it's extended or made permanent, we could see the percentage of seniors paying tax on benefits revert back to current levels. Now, this all applies to federal taxes, and it's also worth remembering that 9 states currently tax Social Security to some extent. The good news is, in most cases, those state-level taxes are applied gently, or not at all, depending on your income. According to a Motley Fool article, 41 states that don't tax Social Security benefits, the list includes Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, Vermont, West Virginia. However, the article adds some interesting details about that list of 9. Hearing that list might cause a little worry for the people in those states, but let's break it down together because the truth is, not everyone living in those states actually ends up paying tax on their Social Security. It all comes down to income. For example, consider Connecticut. If you're a single filer or married filing separately and your adjusted gross income is under $75,000, your Social Security benefits aren't taxed by the state. If you're married filing jointly or filing as head of household, that exemption applies if your AGI is below $100,000. Other states like Minnesota, New Mexico, Rhode Island, and Vermont also have income-based exemptions. The thresholds are different in each state, but the pattern is similar. If your income falls below a certain level, you may not owe any state tax on your benefits at all. And here's some potentially encouraging news out of West Virginia. The state is in the process of phasing out its tax on Social Security benefits. For the 2025 tax year, West Virginians can subtract 65% of their Social Security benefits from their taxable income. And starting next year, that jumps to 100%, effectively removing the state tax altogether. The bottom line is that state taxes on Social Security aren't always a given, but the details can be tricky, and it really depends on your unique situation, your income, your filing status, and your long-term retirement strategy. The USA Today article next addresses who qualifies for the new tax-reducing deduction. Let's talk about a piece of legislation that's probably gotten the lion's share of attention since it was signed into law in June, especially for those in or nearing retirement. The $6,000 tax deduction that could impact how much of your Social Security benefits are subject to federal income tax. Here's how it's currently written, based on the version passed by the Senate on July 1st. If you're 65 or older and your modified adjusted gross income, or MAGI, is $75,000 or less as an individual, or $150,000 or less as a married couple filing jointly, then you may be eligible for the full $6,000 deduction. Now, for people with higher incomes, the deduction doesn't disappear right away, but it does start to shrink. If your income reaches $175,000 as an individual or $250,000 as a couple, the deduction phases out entirely. So, what does this mean in practical terms? It means that many retirees could see a reduced tax burden, especially those with moderate incomes. But it also means this benefit is income sensitive. Now, all of this, the deduction, the income thresholds, the potential tax savings, on the surface, it sounds like good news, especially for those who qualify. And for many retirees, any opportunity to reduce taxes and keep more of their benefits is welcome. But here's where it's important to zoom out for a moment. We also need to keep an eye on the long-term health of the Social Security system. Right now, according to the article, Social Security is facing a projected funding shortfall, and by 2034, it's estimated that the program may only be able to cover about 81% of scheduled benefits if no changes are made. That shortfall is largely due to the fact that more money is going out than coming in, and a portion of that incoming revenue comes from taxes on benefits. So if fewer people are paying taxes on their benefits, this new deduction could accelerate. That could mean even less money supporting the program. In other words, while the deduction may offer relief now, it could also potentially speed up the timeline for Social Security's financial challenges or result in reduced benefits down the road. Again, this isn't about fear, it's about being informed and proactive. This is why thoughtful, personalized strategizing matter. Tax breaks, income thresholds, program projections, these are all moving pieces, and it's our job to help connect the dots in a way that protects your long-term goals. If you have any questions about your retirement magic number, your retirement strategy, or any other parts of your financial strategy, visit my website at m&awealth.com or call my office at 866-973-3627 to discuss how my team might be able to answer your questions and address your concerns. It's our goal to help you prepare for the retirement you've worked so hard for.
Disclosure: all matters discussed during the show are for informational purposes only. Opinions expressed are solely those of M&A Wealth and staff. All topics covered are believed to be from reliable sources. However, M&A Wealth makes no representations as to its accuracy or completeness. This commercial shall in no way be construed as a solicitation to sell securities or advisory services to residents where permitted. Topics should be discussed with your individual advisor prior to implementation. Advisory services offered through M&A Wealth, a registered investment advisor in the state of Texas. Insurance products and services are offered through PNC Life Insurance Agency, an affiliated company. M&A Wealth and PNC Life Insurance Agency are not affiliated with or endorsed by the Social Security Administration or any government agency.